Hello, everybody. Welcome to the Quarter 2 2023 Market Outlook and Commentary. I hope everybody's doing well. Hope everybody has had a great start to their spring. We wanted to focus on three major trends going into Quarter 2 as well as the rest of 2023. The first one being slowing inflation, the second one, political gridlock, and the third is low earnings expectations. So let's dive right in. Again, the first one's slowing inflation. March CPI, which is the Consumer Price Index numbers, came out a few weeks ago, and year-over-year inflation was 5%. Now, this is historically high when we look at previous years. However, this is very far, much lower than that 9% that we saw in June. So inflation is cooling. Seems like it's coming down quite significantly, and will continue to do so. But why does this matter? Well, the Federal Reserve policy is completely contingent on what is inflation doing. If inflation continues to cool, we estimate and believe that the Federal Reserve will stop their aggressive interest rate hikes as they did in 2022. Right now, the market is pricing in a 25 basis point rate hike in May. However, if inflation continues to cool and moderate, we will actually see that number, or we will actually see the Fed pause their interest rate hikes and potentially pivot and go lower interest rates into quarter four, maybe into quarter one of the following year. It's something that we'll continue to keep a close eye on. The second trend, and we've talked about this in previous market commentaries, is political gridlock. Okay, so we had the midterm elections last November. The Senate remained in Democratic control, but the House flipped to Republican control. What does political gridlock ultimately mean? Might mean nothing's really going to get done over the next 18 months, 2 years, while Biden's still in presidency. If something gets proposed in the House and goes to the Senate, it'll probably get rejected, and likewise, if something goes from the House and gets pushed to the Senate, it'll probably get rejected. Now, from a market perspective, this is a good thing. The market enjoys certainty and predictability, and if nothing's going to get done, if there's not big tax changes, if there's not big regulatory changes, the market can do what it's supposed to do and grow. Since 1950, anytime we have a split Congress, on average, the market's gone up 13.4% every time we have a split Congress, no matter who's in the Oval Office, if it's red or blue. So again, a major positive as we continue going into 2023. The third trend that we're seeing is very low earnings expectations. Everybody's doom and gloom right now. Retail investors, institutional investors are predicting a slowdown in revenue and profitability from the major indice companies, the S&P 500, the Dow. Where we're at today, 20% of the S&P 500 companies have reported earnings. Okay, 74% of those companies have outperformed earnings expectations. This is great news. Actually, Microsoft and Google reported earnings after the bell. This was yesterday, and crushed their earnings expectations. So this is a trend we're going to continue to watch closely. But if earnings expectations are low, but companies continue to outpace what the expectations are, it's going to lead to positive market returns. Okay. One question that we're also getting a lot right now is what does a weaker dollar mean? The dollar's weakening from last year. Is this good or bad for the market? And it sounds counterintuitive, but a weaker dollar is actually good for the market. We've gone back and looked at the numbers as far as when the dollar's stronger, what do earnings do, and when the dollar is weaker, what do earnings do? And believe it or not, when we have a weaker dollar, earnings actually do pretty well. We have to remember that we're a global economy, and especially the S&P 500. If we just look at the S&P 500, 40% of the revenue that the S&P 500 companies generate actually come from overseas, non-domestic customers. And with a weaker dollar, it makes U.S. products and services more affordable for non-U.S. clients and customers. So again, a weaker dollar means more affordability, and which ultimately can drive positive earnings. If you click into our market commentary, the broader discussion, it'll actually show a graph of how those two are related: weaker dollar and earnings expectations and earnings beats. But as always, and in conclusion, we're going to continue to monitor everything with a very close eye. If you have any questions or want to discuss or re-review your financial plan, we're happy to do so. Please reach out. We'd love to hear from you. We need to maintain a long-term perspective. The market will continue to claw back. Nobody knows how long that'll take. But again, now more than ever, maintain that long-term perspective. Make sure that the current plan and the investment plan that we have in place for you still equates to the objectives that you want to have for each account. But as I mentioned, love to hear from you. Feel free to reach out. I wish everybody a safe, happy, and healthy spring as we near summer, and a very prosperous 2023. Thanks so much, and we look forward to hearing from you soon. Take care.